will say a few words about our special guest, Mr. Zaman, the country managing partner of PwC Bangladesh.
Thank you very much. Assalamu alaikum, and a very good evening to you all. It is a great pleasure to be able to say a few words about our special guest, Mr. Zaman, the country managing partner of PwC Bangladesh. With a career spanning over 2.5 decades, Mr. Zaman has consistently demonstrated an exceptional ability to navigate complex business landscapes and deliver outstanding results. Prior to joining PwC, Mr. Zaman held a pivotal role at Citibank as the head of corporate banking in Bangladesh. In this capacity, he was responsible for overseeing a diverse portfolio of clients, including multinational corporations, local enterprises, and financial institutions. During his tenure, he also served as head of market sales and structuring and head of structured finance in Bangladesh. His strategic acumen, coupled with his deep understanding of local market, enabled him to drive sustainable growth and foster strong client relationships. Before his role at Citibank, Mr. Zaman honed his skill at a boutique investment bank, where he led capital markets and corporate finance operations. His expertise in these areas, including debt and equity capital raising, mergers and acquisitions, and strategic advisory, has been instrumental in numerous successful transactions. His keen understanding of market dynamics and his ability to identify lucrative opportunities have made him a respected figure in the industry. Mr. Jaman's academic credentials are equally impressive. He holds both an MBA and BBA degree, and he has further enriched his knowledge through executive education programs. This combination of academic excellence, and practical experience positions him as a formidable leader.
I've been given the easiest task to talk about M&A from an economic perspective. So, honorable guests of honor, distinguished guests, and ladies and gentlemen, Assalamu alaikum and a very good evening. So first of all, thanks to Mr. Rahman for inviting me in this August gathering, celebrating the 18th foundation of the Chamber. Thank you very much for that. Today I have the privilege of discussing a topic of immense significance in the realm of banking and finance, that is merger and acquisition, or called M&A, from an economic perspective. So as we navigate through an ever-evolving financial landscape, understanding the economic principles that drive M&A in the market is crucial for both practitioners as well as policymakers alike. I'll discuss 5 principles. 1, scale efficiency. 2, technology efficiency. 3, market failure. 4, opportunity cost. And finally, 5th, risk diversification. So scale efficiency, let's begin with the concept of scale efficiency first. At its core, scale efficiency is about achieving lower average cost through increased size. When banks and FIs merge, they can spread their fixed cost over a large pool of assets, thereby negotiating better terms with suppliers and leverage their size to offer more competitive rates. The merger between Spain's Banco Santander and Banco Popular in 2017 serves as a prime example where Santander capitalized on scale efficiency to strengthen its market position and enhance profitability. Further, given the financial stability risks and increasing complexity in financial products, the central banks globally are also evolving in their regulatory functions. Financial institutions' efforts to offer wide variety of products such as savings, wealth, insurance, payment, and credit means that these institutions are subject to variety of regulations managed by different regulatory bodies. In such environment, there are noticeable benefits to consolidation and reduce compliance burden per customer and remain competitive in the market. As countries transition from exporting full-fledged products to exporting tasks, financial institutions must provide solutions that transcend borders. For example, while majority of iPhone is assembled in China, but we know that a greater number of components comes from many parts of the world. The design is done in the US, the memory chips and displays from South Korea, the camera sensor from Japan, and processors from Taiwan. This has led to companies looking for financial solutions cutting across countries, and thus building case for M&A in banking and FIs to be able to serve different geographies seamlessly. For this digital world, technological efficiency is paramount. Mergers offer banks the opportunity to pool resources for investing in cutting-edge technology and infrastructure. The merger between Deutsche Bank and Postbank in Germany highlights this principle, as it enabled the integration of technological platforms, reducing redundancies, and enhancing service offerings. By embracing technological efficiency, financial institutions can improve operational agility, cyber security, and customer service, positioning themselves to better meet market demands in a technology-driven world. The digital revolution has transformed the cost structure in banking. The marginal cost of serving each new client is declining. Thanks to digital onboarding and data analytics, M&A facilitates synergies between tech companies and financial institutions, allowing them to achieve economies of scale rather than investing in technology organically. Market failure. M&A can also be a strategic response to market failures, such as information asymmetries or monopolistic practices. For example, in India, the consolidation of state-owned banks like the merger of Oriental Bank of Commerce and United Bank of India with Punjab National Bank illustrates how M&A can address suboptimal competition and service provision. However, regulatory oversight remains crucial to ensure these consolidations do not lead to reduced competition, thereby safeguarding the consumer's interests. Opportunity cost. The concept of opportunity cost is central to M&A decisions. Banks must carefully evaluate the potential synergies of an M&A against alternative investments. The acquisition of Merrill Lynch by Bank of America during the 2008 financial crisis exemplifies this principle. Bank of America seized the opportunity to acquire Merrill Lynch, recognizing the strategic value and synergies that outweighed other potential uses of the same capital. Such decisions highlight the importance of timing and strategic foresight in M&A activities. Risk diversification, the fifth and the final one. Risk diversification is another critical lens through which we can view M&A. By combining operations, financial institutions can spread their risks across a more extensive portfolio of assets and geographies. HSBC's acquisition of Hang Seng Bank in Hong Kong is a testament to this principle. Through this acquisition, stability and resilience. Further, we are operating in an increasingly uncertain environment. The world has witnessed a series of crises, from climate change to geopolitical tensions recently. In this environment of uncertainty, consolidation offers a strategic means to strengthen resilience and diversify risks, enabling FIs to navigate these challenges more effectively. In conclusion, M&A activities in banking and finance are not merely about consolidation. They are strategic maneuvers driven by sound economic principles. From achieving scale and technological efficiencies to addressing market failures and diversifying risks, M&A holds the promise of substantial economic benefits. As we move forward, it is imperative that we balance these benefits with the need for regulatory oversight to ensure competitive and resilient financial markets. Thank you for your patient hearing. Thank you.